Hey guys, Courtney Epps here. So we're going to get started. Um, I'm just going to tell you that everything that I'm sharing with you today is going to be a lot of information if you've not seen this presentation before. My goal is to give you as much information and throw at you, what all you can write off, and help you understand that. And then we can obviously help you throughout the way. So, uh, just you don't have to remember everything I'm going to share with you today, I guess is what I'm trying to say. We can definitely walk you through some of these steps, but I wanted to just be able to help you figure out, what all you can write off for having a home-based business or a business. It doesn't really matter. Having a home-based business, there's lots of extra perks that go along with that, but whether you are just getting started in business today or whether you have been in business forever, I think this will be very valuable for everyone on this call today or on this webinar. So I'll just get started. The name of my company is called OTB Tax. We are actually in Greer, South Carolina. That's close to Greenville. I'm a mom of 6 kids. We're actually having another baby here shortly. So I'm super excited about that. Should be any time now. Don't worry if you're my client. That's not a big deal. We're going to take care of you. I'm only going to be out of work for a couple weeks, so we should be good to go. As far as I've been doing accounting for the last 25 years. I consider myself not to be an accountant, but more of a tax strategist. So my goal is to find money, free up money, go back and amend and get money. That's really what I focus on. And then obviously I have a full service accounting firm that handles everything from payroll to bookkeeping to tax preparation. And then I review every tax return that comes to our office. We do about 2,500 tax returns a year. So that's just a little bit about me. And what this topic is today, what I'm going to be sharing with you is why you'd be brain dead not to own a business. And I truly do believe that. I'm not saying that you can not make a good living off of being a W-2 employee, but there are major tax benefits to being a business owner. And if you go through and understand all of these tax benefits, you'll realize that the government really does truly want you to go out and start a business opportunity so that you can get massive tax benefits. And I'll share with you along the way some of the reasons why the government wants us to do that. So a couple things that we're going to learn today. Taxes are our number one expense. I don't know if you realize that or not, but about 40% of every dollar that W-2 employees make go to pay taxes. That is a totally different number when it comes to a business owner, but that's the average. Family household is paying about 40% of every dollar they make in some sort of taxes. And how the average family can actually keep $4,000 to $8,000 a year in their pocket by having some sort of home-based business, which leads me to explaining the two tax systems in our country. The tax system that was created to steal wealth, tax system that was created to provide wealth, and obviously why you'd be brain dead not to own a business. And if you are a business owner, why are 93% of business owners overpaying in taxes? And most of that would be to lack of knowledge. And I'll share with you some information on that. And then the goal is to be able to help you keep $10,000 or more in your pocket this year so that you understand tax benefits. But understand if you're not making $10,000 or if you don't have a tax liability of $10,000, I'm not going to be able to get you back 10 grand. But if you are in fact paying taxes and the average American family household is, then this could help you save at least 10 grand by doing some of these steps that I'm going to share with you. And why we're different from the traditional accounting firm is that our focus is strategy. So we want to help clients save money in taxes. We don't want to just prepare their tax returns. Anybody can prepare your tax returns, not saying they may necessarily be the greatest at it, but people have that skill and can be able to prepare returns. My job is to look at what's not there to see how much we can write off for a client. What are missing expenses? Is their structure set up properly? Should they go back and get money that they overpaid in prior years? And so these are just some of our clients. The most that we've ever gotten back in 1 year was actually $338,000 that someone overpaid. It was because she was structured improperly. Her accountant told her not to be structured as an S corp election. Her expenses, she wasn't writing off anywhere near as many expenses that she was entitled to take, and so she was overpaying in taxes. And we actually went back and got that money back. Same thing with Carrie. Hers was $110,000 a year. Missing expenses, not structured properly. She was paying herself too much in a paycheck. And so we went back and amended everything for 3 years for her. That was as far as we could go back. And I'll tell you this, we've been able to help clients get back over $10 million and help them save millions of dollars every single year. So pretty exciting. Now, you may not know this, but the average American household will spend more money in taxes in their lifetime than they will on food, clothing, and housing combined. So let me read that again. The average American household will spend more money in taxes in their lifetime than they will on food, clothing, housing, and transportation combined. So we have to do everything we possibly can to keep as much money as possible. Now, I know in April, the Trump Tax Cuts and Jobs Act is supposed to renew, and then there's supposed to be some major tax deductions or tax benefits. So I'm super excited to be able to share that. As soon as that comes out, I'll be rewriting my book and sharing that information with you through webinars and things like that. But right now, I'm just sharing with you the way the tax law is today. So the average American household will spend roughly, or going to go in debt, $7,000 to $12,000 a year to work. And so you may say, how is that happening? And then we look at national debt in our country is actually now $104,000. If you go look on US Debt Clock today, it's up from $67,000 in 2020. It's almost doubled, which is absurd. Credit card debt's up, student loan debt is up. So and this is how it breaks down. The average household income in America is $67,000 a year. That's up from 2020 to it was 61,000. The problem is they're going to pay on average of about $14,000 in taxes, which leaves them with a take home of $53,000. The problem is that the cost of living in America has gone up now to $65,000. It's actually more than that. This was a year ago. I have not updated this slide because I think it's so overwhelming for people to even see it. When they look at the numbers, it's like, man, how do we ever get ahead? So the cost of living is $65,000. It was $53,000 in 2020. So if you take 67 minus 14, and minus 65, you're actually going in debt. The average household's going in debt about $12,000 a year to work 40 hours a week, 50 weeks a year to take 2 weeks paid vacation. So the system that we were taught to go to school, get good grades, go get a good job is not currently working. And we obviously taught our kids to do the exact same thing. And it's almost like having to relearn everything that we've ever been taught because it's not working. But when you know it's not working due to lack of knowledge, you can actually change and make decisions. One of the major reasons why people overpay in taxes is because there's no tax planning that's involved. And it's very important to do tax planning in 2025 for 2025. Now, granted, there are some things that we can do to go backwards into 2024, but it's not as significant as if you made decisions right now and later on throughout the year that are going to affect the 2025 tax return. And you don't have to learn all this information that I'm sharing with you. We can handle it for you. We can teach you step by step, how to set these things up. Some of it, it's probably easier for us to take care of it for you so you don't have to worry about the paperwork. But again, you don't have to understand all of this overnight. The first step in freeing up money and putting more money back in your pocket or keeping more of your hard-earned money is to start a business. So if you have not done that yet, that is your first step. And I don't care what that looks like. I don't care if that is a blog. I don't care if you start a network marketing company. I don't care if you get involved in real estate. Um, I don't care if you start a brick and mortar, if that's what you want to do, but understand that brick and mortar, there's lots of money involved in it, startup costs, there's lots of, your return on investment is typically lower than starting something from home. But definitely you can make really good money having a brick and mortar location. So whatever, this is what I tell my clients. Anything that you can do that excites you. So if you love nutrition, find a nutrition company that has some amazing products and start sharing with people about those products. So you can force all of your products to be tax deductible because you're attempting to earn an income. If you if you love let's say the hair care industry, then find a company that has some amazing products and share those products. If you love to stay out in the, outside, maybe start a lawn care company. I don't think the profit margin is very, very good on that, but there are some people that make killer money off of that. What I love about the home-based business network marketing industry is that if you span and allow yourself to have access to have your clientele be anyone in the United States, virtually you can force almost all of your trips to be tax deductible. So we'll talk a little bit later about that. So going into detail, starting a business, why is that? Because there are two tax systems in our country. There's the tax system that was created for the W-2 employee, and there was the tax system that was created for the business owner. And the W-2 employee system is truly to take away your wealth, and the business owner system is truly to allow you to earn income. We push money back into the economy every single day. We are then hiring employees, and then those employees pay the lion's share of taxes. And so you may say that's not fair, but if there weren't businesses, there wouldn't be employees. So we have to get major tax benefits in order to have the employees and be able to hire them. And you will always pay less in taxes as a business owner than you will as a W-2 employee. And I actually created this slide to kind of break it down for you. So you understand, as a W-2 employee, let's say you're making about $100,000 a year. That $100,000, you only get really a standard deduction, or you can itemize. The majority of Americans, I would say 96% of them, are getting zero benefit from itemizing. And the reason why is because the standard deduction is so high and there's so many limitations on the itemized deductions that it's better to take the standard deduction for most people. I think that's going to change here in the next couple months. Then you have from there are FICA taxes, federal and state taxes, and what's left over is a take-home of $71,000. Well, if I take a business owner, same $100,000, now we get to deduct our business expenses from that. So let's say there's $25,000 worth of business expenses. And I'm not talking about expenses that are extra for the business. I'm talking about things that you're already spending money on, like cell phone, internet, meals, travel, business use of home, all of those. So we have $25,000 in business expenses. That gets us to a total income of $75,000. Then you have something what's called the QBI deduction, which says that you don't have to pay taxes on 20% of your income from business. So that's $15,000. So deducted from the 75, that leaves us with 60. That is our total income. Then we get to deduct from that the standard deduction, which is $15,000. So this is an individual person, just so you know, standard deduction is $15,000 per person. So it would be $30,000 per household. From there, now we're paying taxes on $45,000 instead of paying tax on $85,000. And the take home is $14,000 difference. Guys, that's a huge deal. I mean, that is such a big deal for people. And now we're not going in debt anymore. So I talked to you about the average households going in debt $12,000 a year. You just completely shifted, and now you're starting to put money in your pocket. So why do business owners get massive tax breaks? It's because 70% of all jobs in this country are actually created from small to medium-sized businesses. When you understand that, we have to have more businesses in order to create more jobs. And so Congress knows that and then gives us massive tax benefits around that. And why it's important, obviously, to do strategy, we talked about that already, is 40% of all salaried employees, or 40% of all income, all of the money from salaried employees is going to pay taxes, period. So we've got to do something about that. And the reason why I'm sharing this with you is not because I learned this in college. You know, I obviously went to a public college and they told me what they wanted me to know, which was how to file tax returns. They taught me how to be scared to death of the IRS. They taught me that if I were to overly take expenses for my clients, they would be audited, and then my client would have to pay all these penalties and fees, and then I could potentially lose my license. They told me all these things. They were major scare tactics. And I want to share a scare tactic with you right now, which I think is crazy, that I just discovered. Is a couple years ago, the IRS, said they were hiring 87,500 new auditors to come in and audit us. And I've noticed over the last 2 years that we've not had any more audits than we ever have. There's not been any more paperwork sent to our clients than there ever has. And so I just knew that seemed to be crazy. So I went and Googled how many employees worked in 2022 in the IRS, which was about 71,000, and then how many worked in 2023, and it was 90,000. So literally, they'd hired 21,000 people, said they were hiring 87,000 to scare the people to death, and literally that it was just a scare tactic. So people would not take advantage of the tax deductions that they're entitled to take. So how I learned all of this was being a business owner, knowing that I had all these expenses and that I could write these things off. And so, I learned over time to start sharing this information with my clients. And I'm a good tax strategist, not because I'm a good accountant. It's because I have been a business owner and tried to do everything but, because I don't know if you guys know, but taxes are not fun. Paperwork is not fun. Sitting and talk about taxes all day long is probably not fun for for most of you. But I love freeing up money. And that is what I believe that I was put on this earth to do, is to help people have a better life. It's not to prepare tax returns or to do paperwork. So I'm just sharing with you everything that I do for my business and my family. Now, what I did actually, and how I got really involved in the home-based business space, is that I actually was in a network marketing company and I started doing taxes for people in that company. And they were W-2 employees the year before, and then they started their business. And I ended up doing over 900 tax returns and proved to people that they could save between $4,000 and $8,000 a year in taxes by just attempting to earn income and staying in their home-based business. And most home-based businesses in no way, shape, form, or fashion cost an extra $4,000 to $8,000 a year to be involved in. But because they attempted to earn income, it was saving them more money, $700 to $800 a month off their taxes, and they were able to afford and free up the money for them to be able to stay in the home-based business, get involved, stay involved, do all the things that they need to do, like continuing education and traveling and growing. They could do that and then get massive tax benefits and keep more money in their pocket. And so that's when I started sharing it. Now, 93% of all business owners overpay in taxes, and there's four main reasons. One is lack of knowledge. They just don't know. They don't know what structure they should be set up in. They don't know what expenses that they're entitled to take. They're not doing any strategy on the back end. And one of the biggest reasons why they're not is because they're not keeping up-to-date bookkeeping. So it's very hard for me to tell you what to do now if I don't have a set of books that tells me what your net income is. You can tell me all day long what your gross income is, but that doesn't tell me what you're going to actually have to pay taxes on. So it's very hard for me to give you that advice unless you are doing your bookkeeping or somebody like we are doing your bookkeeping. Somebody needs to be doing that. Second, they're scared of an audit. So expenses have nothing to do with being audited. I just want you to know that. I actually didn't learn that from college yet again. I learned that from a CPA and an IRS tax attorney by the name of Sandy Botkin. And so I read his book, Lower Your Taxes Big Time, about 8 years ago now. transformed my entire practice, because I started using what he teaches. And he was an IRS attorney. He trained other attorneys for the IRS. So what he teaches is sound. And I started utilizing that and realizing that expenses have nothing to do with you getting audited. Actually, if you have a huge increase in income or a huge decrease in income, that's what triggers an audit. Meaning you go from making $500,000 one month or 1 year to $250,000 the next year. That could trigger an audit, and vice versa. The third reason why people overpay in taxes or business owners is that their accountant is not allowing expenses, or they're giving them bad advice. And I see this every single day. People are told, well, I don't need an S Corp because I don't make over $100,000 a year. It's just math, guys. Like, literally, if it's cheaper for you to be an S Corp election and to save money in taxes, I'm going to tell you this is how much you're going to save. This is how much it's going to cost. If it costs more than what then you would get back, it doesn't make sense to do. But if you're paying in taxes and this is how much it's going to cost for us to do the work, and we are less than the taxes, and you get to write us off as far as a business expense, that makes sense. So, there's so much bad advice out there. And then the fourth thing is their accountant is not providing them strategy. And 9 times out of 10, accountants are accountants. Like, they do tax returns, they don't do strategy. So they're only preparing, and that's not helping you at all. And 3 easy ways to help keep more of your money is making sure that you're tracking all of your expenses and writing off everything that you are using to attempt to earn an income. And we'll go into more details on some deductions a little bit. You are structured properly. That's a huge deal, that you have, there comes a time where you need an LLC, and then you take that LLC and treat it as an S corporation. I don't think you need to be anything else, but once you get to a point where your income is high enough, you would want to be structured. An LLC is treated as an S corp. And then third, when you are structured as an S corp election, then you want to make sure you're paying yourself the least amount in a paycheck. That will help you reduce tremendously the self-employment taxes. Now, let's get into detail on what a tax deduction is. So this is exactly what the IRS says is a tax-deductible business expense. It says that any expenses incurred for the purpose of gaining or producing income, meaning so you're trying to make money, right? It's incurred with a reasonable expectation of resulting in future business. So you're trying to make money today or in the future. And it's reasonable under circumstances, meaning that I'm not telling you that being able to ride a Bugatti or a yacht off today is beneficial or reasonable if you're making $5,000 a year in your business. But if you are going to a continuing education event and spending $5,000 or $10,000, and you're making, if you're making 10 grand on your business, that is a reasonable expense. So there's lots of reasonable things that you can write off. And as long as you are, again, attempting to earn income either today or in the future, and it's reasonable, then it's tax deductible. And the great thing about having a home-based business is that you're able to redirect your living expenses and turn those into business expenses. And we'll talk some more about that. And the way you do that is by doing something called daily business building activities. What are daily business building activities? That means you're attempting to earn an income you're attempting to earn income 3 to 5 days a week for 45 minutes at a time. That's what the IRS considers you attempting to earn an income. So I think everybody has 3 to 5 days a week for 45 minutes at a time to attempt to earn income so that they can then get these tax deductions. Now, the great news is that when you first get started in business, obviously on paper, not necessarily true, because on paper you get to write off all these deductions. You may not necessarily have all these extra deductions, but on paper, if you show a loss, you can offset that against any other income that you have, W-2 income, it can be dividend income, interest income, rental property, Social Security, all of that good stuff. So, and if you have more losses than you have income in one given year, those can be carried forward forever. So you can take them every single year towards any income that you have. Now, as far as deductions that we're entitled to take, there's a ton of them. And I will actually send an email to every single one of you on this call with a link. I just finished up a long deduction spreadsheet. It's got 180 different deductions. It is a long version of the one sheeter that we typically use for our clients because everything pretty much on that 180 is combined into like advertising, maybe business cards and greeting cards, and it could be subcontractors and dues and things like that. So all of those are just detailed out and give descriptions. I just finished that today, so I will send that in an email to each one of you when I get off of this webinar. But we want to understand how to convert living expenses into business expenses, so we're not spending more money to save money in taxes. We're just utilizing what we're currently spending today. And so that gets me to being able to break down for you a W-2 employee versus a business owner. Or it could be a W-2 employee with a home-based business. You don't have to quit your day job in order to get the tax deductions that I'm talking about. You also don't have to have a structure set up in order to get the tax deductions I'm talking about. A lot of people believe they have to get an LLC in order to take advantage of these deductions. No, it has nothing to do with the structure. It just has to do with when you start attempting to earn an income. So if tomorrow you signed up for a home-based business, you're attempting to earn income. If tomorrow you decided, hey, I'm going to be in the social media industry and I'm going to start sharing content and I'm going to start making money off of that, you have started a business. Well, when you have a W-2 employee, they only really have living expenses that are not deductible at all, and they have itemized deductions. And so itemized deductions, there are caps. Now, one of the things that I'm super excited about in the new tax law that's supposed to be coming out in the next couple months for 2025 is that the taxes are no longer capped at 10 grand a year. So it was property taxes, real estate taxes, income taxes, all of those, you couldn't go over 10 grand a year towards your standard or towards your itemized deduction. That is going to change. But right now, 2024, that's the way it is. So the cap is 10 grand. Medical bills and medical insurance, most people don't get any benefit from them. And the reason why is because you have to go above 7.5% of your adjusted gross income in order to get $1 of a benefit. So if you made 100 grand, 7.5% of that is $7,500. You'd have to, let's say you had $8,000 worth of medical bills, only 500 of that will be included towards your itemized deduction. So you can see how that's not very beneficial. Now there's ways to add those things back. Then you have mortgage interest. If you have a house over $750,000 a year, you can't claim mortgage interest on anything but the $75,000 and under. And then you have charitable contributions. So charitable contributions, you can claim up to 60% of your income, adjusted gross income on charitable contributions. But again, all of these combined, if you don't go over this year $30,000 if you're married filing jointly, and if $15,000 if you're married filing separately or single, then you don't get any benefit. You're just going to get the standard deduction. And the living expenses, the only one on here that you may get some benefit for is dependent daycare, and it's about $2,500 per child per year is the max that you can get off of that. And I know people are spending far more than $2,500 per child for dependent daycare. Now, when you add on a home-based business, all of these things can now be tax deductible. 100% is a business expense. So medical bills and medical insurance, that you can start what's called an HRA, which is a health reimbursement account. We'll talk a little bit more detail about that in a little bit, but essentially you hire your spouse then in turn pays all the medical bills. As an employee benefit, you reimburse them for the medical bills and medical insurance, and it's 100% tax deductible as a business expense. Things like property taxes. So if you have an RV that you're driving around for your business, if you have a vehicle that you're using for business purposes, if you're using a portion of your home, a portion of your property taxes can be tax deductible. Business use of home, this one I love. So you can write off if you have a specific location in your house. Let's say you have a room that's set aside specifically for an office or storage or things like that. Then you can write off based on that business use percentage. And here's the kicker. One thing I really love about business use of home is you can back out closets and hallways. You don't have to include them in the total square footage of your home. So that increases the percentage of business usage. So I really love that part. Charitable contributions. So we're going to talk a little bit more in detail on how to add those back in just a few minutes. So I'm not going to get involved in that here. Now, granted, we have things like mileage and meals and cell phone and internet and travel. All of these things are tax deductible. We will talk more detail on hiring your kids and office supplies. But on here, just so you understand, there what I'm showing you are kind of averages that I see on people's tax returns. They're not minimums or maximums. There are no minimums or maximums. They are just 100% tax deductible as business expenses. But these are not extra expenses. These are things that were already in the left-hand side category for the W-2 employee. Now, extra things that we may have, advertising or continuing education, or we may have dues like monthly subscription fees, and we may have cost of goods sold. So some of you that are reselling product or, listing and advertising would be your own product that you're using to tell your story, right? Because you have to take the product in order to tell people about the product. So if that is the case and you're doing that, obviously you can write that your products off as advertising. So these totals that I'm getting to is about 35 grand. And I just want you to see how this works. So it makes perfect sense to you. I'm not even going to use that 35 grand because I think these are very easy numbers to reach. I think people spend way more than that in meals. They spend way more than that in mileage, cell phone. All of these things are just averages that I'm seeing. Well, the great part is that 35,000, let's say, depending on your tax bracket, the majority of Americans, their highest tax bracket is 22%. So if you're at $35,900, 22% of that's 8 grand in taxes that you save. Right? So let's just say $25,000 of that money. If you just had $25,000 in expenses, didn't make any extra income, now that is $5,500 in tax savings. So it's a huge deal. And again, the majority of Americans their highest bracket is the 22%. So if you're making over $80,000 per household, it's to 22%. So shifting your income. So let's talk a little bit about hiring your kids and shifting income off of you and onto them. Now, one of the things that I have done for my business, and we've done this over the last 5 years, is that each year we give a percentage of ownership to our children. And the reason why we're doing that, one, it's a huge tax savings. We're shifting income off of us at a 37% tax bracket and onto our kids at 0, 10, and 12% tax bracket. So big deal, especially as our kids get older and older. Most of them are over the age of 18 now. We definitely want to give them more of ownership of the company. We're obviously giving them more responsibilities in the company. And so we have shifted off 30% of our ownership onto our kids. So we're not paying taxes on that money. So we're paying some taxes. It's just very minimal comparable to what we would pay. Now, you can also do the same thing with hiring your kids. You can hire your kids and you can pay them to do work for you. They could clean the yard because you have a home-based business. They could help clean up your office. They could help file files. They could help you with social media marketing. You could pay them to market for you. So all of these things, obviously, anything that you would pay someone else to do, you can pay your kids to do. And kids are obviously expensive. They have, everything under the sun that they want these days. But then you also have things like vacations and you have school and education and all of these things. So you can pay them and then they can in turn pay for their stuff. Now, there's a couple caveats to that. One, you need to have a bank account with their name on it. It can also have your name on it. You have to transfer the money over to them, and you have to actually do the paperwork to process payroll, meaning that you have to process payroll tax returns every quarter, issue W-2s once a year if you pay them over $600. We can obviously help with that. It's inexpensive. It's about $500 a year for us to take care of all of that for a whole entire year for kids' payroll, for regardless how many kids that you have. But here's the kicker. You can pay them up to $15,000 per year per child. So if you have 4 kids, that's 60 grand that you can wipe out. And let's just look it up. $60,000. If I take 60 grand and 22% tax bracket, that's $13,000 it would save you in taxes. Now again, the money that you give to the kids, that money can be used for anything. You can't transfer it back to your personal account, but you can give that money to your kids. You can set up a Roth IRA for them if you want to, because now they have income. You can pay for vacations with it. You can do whatever you want. So, that being said, the second caveat to that is that if they're under the age of 18, you would want to pay them through a Schedule C, so that there's no taxes at all whatsoever. So we can help you set all that stuff up. If you have an S Corp, you wouldn't pay them through the S Corp right now. You would pay them through a Schedule C. And the reason why is because it allows us to bypass all taxes, unemployment, state, federal, FICA, all of that is taken care of. So, and FUTA. Now, there's also some other benefits on why you would hire your kids. One, and that I really love, is continuing education. So you can take them with you to events. They get to learn the same information that you're learning. They get not only the education, but they get the exposure, they get the networking. So they're learning marketing right along with you. The other thing is the travel. So anything travel related. So if you're going for a work event, if you're going to a continuing education event, you can take them along with you and travel. And what I love to do is that I will kind of sandwich in, a couple days on the front end or a couple days on the back end, and we'll go and just do whatever we want to do, just fun stuff and hang out. Granted, entertainment is not tax deductible, but everything else is. So auto reimbursements, you can reimburse their vehicles as well if they're doing work for you. College education, so this up to $52.50 a year, you can actually give them a college education. So again, we're adding back deductions that we don't get as W-2 employees. And then one of my favorite is you can hire your kids. You can have a swimming pool, an exercise facility, a golf course, or a tennis court. This is tax law. This is literally written in the tax law. If you allow your employees to utilize these facilities, and your children could be your employees, then these things are tax deductible as long as it's on the property that you are employing them in, which is one major reason why you'd want to have a home-based business. If you have a brick and mortar, think about adding something on that you can then hire your kids and put in a new swimming pool. So travel expenses. This is one I really love. And most people don't understand how travel expenses work. So you have the ability on the road, meaning you're driving, you're flying, it doesn't have to be your car. It could be a rental car, whatever. Anything on the road is considered sustaining life, and all food, laundry, travel, housing, laundry, all of that is covered. And then the meals are 50%. So that did change last year with the 2024, it went away. 2025 from here on forward, as of right now, there will be 50% deduction for meals. So all of that can be written off. And a great thing we'll talk about in just a second, I have a slide on it, is that you don't have to keep receipts under $75. Now, granted, if you take a lot of people with you, you're never going to get under the $75, but that is one big thing about travel receipts, is that if it's under $75, you're not required to keep that. If you ever get audited, you don't have to worry. Transportation. So if we are cost of getting there to and from, so all of that can be tax deductible. You've got expenses for meals. I just talked about that. There's a limitation of 50% for meals. And then again, no receipts are required under $75. Well, let me give you a scenario that I really love. So let's say we did a tax class in Puerto Rico. And so I scheduled this tax class, and obviously I would schedule it to force it to be as much benefit as possible, much downtime as possible. So I would do a Thursday. We would fly in on a Thursday. We would not have to do anything that day. There would be nothing, maybe a check-in, for 30 minutes, 45 minutes, whatever. But the whole entire day, because that is considered a travel day, is 100% tax deductible. Friday, we have a 4-hour and 1-second seminar that goes into detail on taxes. And this could be anything. So it's not just taxes. It could be a continuing education event or whatever. Then Saturday and Sunday, or excuse me, Friday, that whole day, let's say 8 to 12 is 12:01 is the event. Now I've done 50% of my day has been allotted to my business. So that's all I need to put in. That means I can do whatever I want to the rest of the day. My travel, my lodging, my food, all of that's tax deductible. Same thing, Saturday and Sunday is considered a weekend. So you're actually, if you have something to do in that same location on Monday, you can sandwich that in. So that's all tax deductible as well. So you don't have to do any work on Saturdays and Sundays. Then on Monday, we have another 4 hour and 1 second version of the seminar. And then on Tuesday, you fly back home. Now, every single bit of that is 100% tax deductible, other than, again, the 50% on meals. So when you understand that, you can figure out how to virtually write off everything. So centered around events, centered around going to meet with clients, prospects, or, upline, downline, sideline. So you can virtually force anything that you're currently doing to be travel deduction instead of writing an office vacation. So there's that. Medical bills and insurance. We talked a little bit about this. In order to write off medical bills and insurance, you have to have something called an HSA, which I don't suggest, because you still have to pay FICA taxes. Or you can have something called an HRA, which most people don't know about. It's called a health reimbursement account. And a health reimbursement account is nothing more than exactly what it is. Exactly what it says, health reimbursement. So you actually utilize, how this works is you would hire your spouse, you would pay your spouse $100 a month, and then your spouse would in turn cover 100% of the medical bills and medical insurance. Now you have to have an actual plan in place, so we can help you with that. If your medical bills are over $5,000 a year, or insurance, or combined, obviously, you definitely want to put an HRA in place. And then the other option, or the other reason why you'd want to do it, is if you have a medical sharing plan. So medical sharing plans, as of right now, are not tax deductible. In place of medical insurance, I obviously believe wholeheartedly in medical sharing. That's a much better plan. But unless you have an HRA in place, you cannot write off medical sharing. But if you have that in place, all of your medical bills, all of your medical insurance, all of your medical sharing, all combined, becomes 100% tax deductible as a business expense. The only thing you have to do is hire your spouse. We can set them up on the same account that we do kids' payroll, so there's no extra expense on that. Get the HRA, pay the spouse $100 a month, so you're out about $100 a year in taxes for payroll taxes, and then that all of the medical bills, medical insurance, and medical sharing becomes tax deductible. So there's that. Now, 96% of Americans, like we talked about earlier, get to benefit from itemized deductions. So that's why this medical sharing is so important, because medical sharing is limited, or the medical insurance and medical bills on itemized deductions is limited to 7.5% of your AGI. Anything above that, you would be able to write off. But the HRA allows you to write off everything. So that's the benefit of having that. And it becomes a business expense as opposed to a personal expense. So again, you hire your spouse, you pay them $100 a month, you get an HRA in place, and then we write off all the medical bills, medical insurance, and medical sharing. And we can help you with that. Then let's get into the Augusta loophole. So we talked a little bit about earlier the business use of home portion. This would be in place of business use of home. It's called the Augusta loophole. The reason why it's called the Augusta loophole is because it originated during the Augusta Masters, or the Masters in Augusta. And what it said is that you can write off your home 14 days a year. You don't have to pay taxes on any money that you receive from your home for 14 days a year. And you can rent that home to anyone. So a lot of times in Sturgis as well, huge bike rally out there. They're literally, the people will move out for 2 weeks. They'll allow people to come in and rent their home. That's 100% tax free for them. They don't have to pay taxes on it. And it's a huge income for them. So you can do that exact same thing with your business. Let's say that you host events. and you're typically hosting them at a hotel. Well, why not host them at your home? And you can get the same price with you personally can receive that income as you would a hotel room or a ballroom or any other event center. So let's say it would cost $500 a day to rent out a facility at a hotel. You can rent out your house for the exact same price up to 14 days a year. So that could be for people to come over for presentations. It could be for training events. It could be for overnight, events that people come over and learn from you. So that's considered to be the Augusta loophole. That is much more powerful than business use of home. So for the most part. Now, another thing that I really love is continuing education. And we'll talk a little bit about market research. So continuing education is obviously, that could be Tony Robbins events. That could be going to Eric Worre events. That could be going to your network marketing company events. So they're great because, one, they give you the benefit of being able to see other people who are winning in that area, be able to learn from them and take their advice so that you can come back and do the exact same thing. But it also, there's such an excitement and almost a belief that is built in when you're going to continuing education. What we have been able to do, I went to my first Tony Robbins event, and it wasn't even an actual Tony Robbins event. It was just 3 hours in a room with Tony. I spent $50 on it. We were doing about $35,000 a year off of our business. That was in the middle of 2017, and our business did 3.6 million last year. The only reason, obviously, I put in a lot of work, but my mindset was really messed up. And so I went to an event. I learned some things that I was doing incorrectly. I was self-sabotaging myself. I had massive limiting beliefs. And I learned in that time frame that I got to choose whether I was happy or sad or miserable, regardless of my circumstances. I got to choose. And so that $50 has, skyrocketed and made us millions and millions of dollars since 2017. So that's what continuing education I see is the one thing that you can spend money into that's going to massively grow your business and grow yourself at the same time. But it's also fun, and there's massive tax deductions to go along with it. And then you have things like market research. So if you're trying to investigate another business that you want to start, or, let's say you're in the rental real estate properties and you want to go to another area to research if it would be good to start, buying rental properties in that area. Anything like that. Or if you want to go, look at a franchise, you can do market research on that, and you can actually write off all of that, the travel, the meals, the lodging, all of that can be tax deductible, as well as any expenses incurred from that. Now, let's talk about structure. So deductions aside, I will send you that deduction spreadsheet. So I will send it to you in the morning to each of you that are on this live or on this webinar. And so you understand 180 different deductions that you can write off. But as far as business structure, that is one of the most important things that you can possibly do for your business when you start earning an income. And what I have found as far as the business structure, the least expensive to set up is an LLC. And then we have the option to treat that LLC as either a sole proprietorship on your personal tax return, or you can treat it as an S corporation. So let's dive in on how that works. First, once you get to a point where you're making about $12,000 a year net income, or $1,000 a month, I suggest that you have an LLC in place. That is specifically for network marketers. If you get to a point where you start a business, I don't care how much money that you're making. If you have any liability in that business whatsoever, it is very important that you go ahead and get an LLC in place when you start the business. An LLC is nothing more than a limited liability company, so it limits your liability. And so it's very important to have if you're starting a business. If you're in network marketing, there's not a whole lot of liability, so I don't necessarily suggest or that you don't need to have it until you start making money so that we can later treat it as an S corp. Now, one of the biggest expenses that you have as being self-employed is what's called self-employment taxes. Now, you're paying half of that as a W-2 employee, which are FICA taxes, and your employer's paying the matching FICA taxes, which is 7.65% for each of you. That comes to 15.3% in self-employment taxes. So add those two together. So if I'm making 60 grand a year in income from the business, that's $9,000 in self-employment taxes. Now, there's a way to not have to pay those self-employment taxes. We now have an LLC, and we then treat that LLC as an S corporation for tax purposes. In order to do that, there's one caveat. There's two things that have to happen. One, you have a corporate return every single year, so it costs a little bit more money for us to file the tax returns. But the other thing is you process payroll. The first year, we don't have to necessarily process payroll. We can show that you have paid yourself something so that we justify the requirements for having the S Corp. But let me break it down for you. If I'm making that $60,000 in income, 20% of that is what you would pay yourself on a paycheck, which is $12,000. And that would be the only thing that you would pay self-employment taxes on. Not the entire 60, which is 9 grand, but the 12,000, which is 20%. That's 1,800 bucks, which is a $7,000 savings. So that's huge. The more money you make, obviously, if you're making $100,000 a year, 15.3% of that is $15,000. So instead of paying $15,000 in self-employment taxes on the entire thing, you would pay $3,000 in self-employment taxes if you're an S Corp election. And where that becomes beneficial is when you get to a point where you're doing about $12,000 to $15,000, depending on state, in net income. And net income is after expenses. So you have your gross income minus the expenses. What's left over is your net income. So if it's over $12,000 to $15,000, you are overpaying in taxes if you do not have an LLC treated as an S corporation. Okay. Another reason we talked a little bit about this, being a business owner, but we talked about the QBI deduction. So QBI is qualified business income deduction. That means that you don't have to pay taxes on 20% of your net income. So if we take that same 60,000, 20% of that is 12,000. Let's say roughly the average federal and state taxes is 25%. That's another $3,000 in taxes. These two things are total 10 grand that we just talked about. So you can see how that can really add up. Now, turning charitable contributions into business expenses. This is one of my favorite tax deductions of all time, is to be able to force charitable contributions to be a tax deduction. Now, I truly believe if you help enough people get what they want, you'll automatically get what you want. And what I believe that I was put on this earth to do was to teach more people how to save more money so they could have more, live more, and give more. And then in turn, I can nourish more and free more children. So that's really my passion, is to provide advanced immune support to children in need through a nonprofit called Manna Relief. And so I'll give you my example of what I've done. So we've taken our gross income and we have decided that we're going to provide a serving for every dollar that comes in our accounting practice. And so, you know, and it doesn't have to be that much. So it could be for every $100 you're going to provide $5 to something. It could be for every customer that you get, you're going to do something. So you don't have to do it exactly the way that I'm doing it and that I've broken that down, but you just have to have a model of giving. So, and I wouldn't go down from that. I would go up from that. So start off small and say, I'm going to give 1% or I'm going to give 2% of my gross income. And so that's very important. It has to be given from a gross income level, not a net income level. So it has to be given with the intention of, this is what I'm going to do regardless if I make money off of this business or not. Through that, we've been able to provide over 10 million servings of advanced immune support to children in need. And you can do the exact same thing. You can find a charity that you love, that you want to give back to. It could be your own nonprofit, but you need to provide, based on your gross income, what are you going to do? Or based on how many clients you bring in, what are you going to do and what are you going to give back? And if that's your business model, that is now considered a cost of goods sold item. It's no longer a charitable contribution, and it's 100% tax deductible as a business expense. And guys, we don't want to leave money on the table. Obviously, we can go back and amend tax returns. And here's a lot of people do not know this, but you can go back 3 years from the date of filing. So right now, you can go back to 2021 through April 15th, or if you filed it later, we can obviously go back 3 years from that date. You can do 22, 23. Those can all be amended, as well as 24. And then anyone who owes money in prior years, we just had a client that we've gone back now to 2013. We've amended all of their tax returns and we've gotten them back 75 grand that they overpaid. Now, granted, they owed this money, so we're decreasing their tax liability by 75 grand. If they had gotten refunds, or if they had paid the money that they owed, we wouldn't be able to amend those tax returns other than the past 3 years and get the money back. But because they didn't pay it and they got hit with penalties and interest, not only can we wipe out the tax liability by amending the returns, but we can also get rid of penalties and interest. So if you're in this situation, don't work with these chains that say we're going to go to work and we're going to get you an offer and compromise and things like that. It's better to amend the tax returns and guarantee that you can get yourself the money back, or, owe less money in taxes, than have these fly-by-night companies try to sell you on, that they can get an offer and compromise, because most people don't qualify for an offer and compromise. It's literally on the IRS website. You can go to OIC calculator and you can type in your information if you do owe back taxes, and it will tell you whether you qualify or not. And if you don't qualify, there's no point in going any further. It takes like 5 minutes. So anyway, and when you start making money, there's so many more ways to keep your hard-earned money. And the reason why is because, again, the bigger we get in business, the more employees that we hire, the more money that we're pushing back through the economy. And the government knows that, and they give us these massive tax deductions. If you're in a higher than 32% tax bracket, we can talk about things like conservation easements and investing in natural gas and other investment options that you may not have ever even heard. And I want to take this time for just a second, guys. If y'all have any questions, you want to put those in the chat. I'm going to answer those in a few minutes, so I'm almost done. And I'll be happy to answer any questions that you have, especially anything that I've not brought up or you want me to go into more detail. Having, as a W-2 employee, like we talked about earlier, you truly make your money and then you pay taxes. And hopefully there's money left over to buy all of your needs, definitely, and some of your wants. But as a business owner, you truly are in the wealth system, because you make your money, you have your business expenses, aka living expenses, your wants and your needs, and then you pay taxes. I'm not telling you can write off everything, but there's so many things that you can take advantage of in the tax law. That's not a loophole. It's just tax law. Because you are attempting to earn income, you get these tax deductions. And that is the wealth system. That's where we want to be. So obviously, I don't want you to be brain dead. I want you to have a business. I want you to attempt to earn an income. I want you to put in 3 to 5 days a week for at least 45 minutes a day. Obviously, if you're really gung-ho and you want to walk away from your 9 to 5, if you're a W-2 employee, and start a business, it takes time. One of the things that I've talked about a lot lately is that, we're having our 7th baby here shortly in the next week or two. And I worked my butt off from the time I was 19 years old until I was 40. And then I got to a point where I didn't have to work 80 hours a week anymore. But I did put in 70, 80 hours a week for a really long time. And a lot of what I did, I had businesses, I've ran them in the dirt. I've lost everything a couple times and gained it all back, but I learned that stuff through experience. And over time, I got better and better and better. And now, because of the sacrifice that I gave then, I now get to, work 15 or 20 hours a week outside of tax season. My kids work for us, and they will have a legacy that will live on forever. And so they don't have to go work for anyone else. They don't have to decide what they want to do. They can literally pick, do I want to do marketing? Okay, we'll come do marketing for OTB Tax. Do I want to do taxes? Come do taxes for OTB Tax. Do I want to do sales? Do that for OTB Tax, so that we can keep the wealth in the family. And so That's the benefit of having a business that a lot of people don't ever get to share, is that you can continue to make generational wealth with that business. So don't be brain dead. Decreasing taxes is the fastest way to wealth. Obviously, I want to help you keep as much money as you possibly can in your pocket. And these are just in summary, there's never been a better time to start a business and to continue building that business so that you have massive tax benefits with the new tax laws. And take the deductions that you're entitled to take. Don't let anyone tell you that you can't take advantage of these deductions. The IRS law is very simple. If you're attempting to earn an income today or in the future and it's reasonable, it's tax deductible. So write it off. Hiring your family. If you have medical bills, medical insurance, we need to talk about an HRA. That would be the only reason you would hire your spouse, because you can take your spouse with you to events if he's helping you build a business. He doesn't have to be your employee. Hiring your kids, obviously that's huge. That's income shifting. You shift off income off of you and onto them. It's also a great estate planning option if you start giving ownership of your business over to your kids as well, and tax savings. Hiring an accountant. I think this is super important. Most people that I see don't necessarily go online and do TurboTax and H&R Block. What I would tell you is you need to find someone who understands your industry and is willing to fight for you. So if the first thing that you ask question to a tax preparer is, will you handle an audit, and how do you feel about my industry, and they give you sideways answers on that, you probably want to find someone else. If you're self-preparing a tax return, I'm just going to tell you this: you are far more likely to be audited than someone who goes to a tax preparer. And the only reason is because we have to fill out paperwork saying that the information that you provided us, that we have proof of that information. So that makes you less likely to be audited. So just keep that in mind. You want somebody who's going to be on your side, not somebody you have to argue with every time you want to take a tax deduction. And as far as conservative goes, that just means they're scared. So they're not going to fight for you and help you in the event of an audit. So just throwing those things out. Tracking deductions is very important. There's a link at the end of this that's going to show you a really good software. It's comparable to QuickBooks. QuickBooks is running around $65 per month right now. I think that's super high for people that are just getting started business. And Hurdler is a great option to that, and it's about $15 a month. So I definitely would suggest that you check out Hurdler. It'll allow you to pull in your bank statements, your credit cards, just like QuickBooks will. It'll GPS locate your mileage. It'll allow you to upload your receipts. And so that makes you more audit proof if you do get audited. Now, I want you to share this with everyone. I will make a recording of this afterwards, and I'm happy to send it to everyone. I'll just send it to everyone after I get off of here as well, along with that deduction spreadsheet. So you'll have that. And let's see, here is my connection. So my contact, you can book a tax strategy session here. And, we're full service. So we go back and amend tax returns. We can do bookkeeping, payroll. We can do taxes, all of that good stuff. So if you're looking for an accountant and a strategist all at one time, that's us. So you can book a tax strategy session with us. This is a free 15-minute call with me. And so I'm just going to tell you what you should do, what you shouldn't do, what you could write off, what we could go back and get. I'm going to give you our prices, and if you like them, that's great. I will invoice you, and we'll go to work on your stuff. So once you pay the invoice, so that's kind of the way it works in our office. We're not hard to get along with. If you want to be our client, that's great. We want you to be our client. If you don't, then we're not gonna pressure you at all. So you can book a tax strategy session there. And then here is, again, that same link, but you can also, we have a lot of clients that refer members to us or refer clients to us. So you can actually get access to my link tree that has not only, my TEDx talk, my I think it actually has all the links to my connections like Facebook, Instagram, all of that good stuff. And it has links to refer people. If you refer someone to us, you get a $50 credit. Obviously, if you're not our client, then we would reach out to you and get, access to your information so that we can send you that $50. But there is a $50 referral fee. That we pay to our clients. And so the bookkeeping software that I talked about earlier, that is connected here. So you might want to take a picture of this slide. And that is it. So I think I've thrown enough at you guys tonight. Let me see if I have what kind of questions we have so I can answer those quickly. When you get to paying your kids, would the same apply of hiring your grandkids? Yes. So grandkids, you can do the exact same thing. And for those of you, you can hire your parents as well. You just have to withhold FICA taxes on them, and they have to pay the matching FICA. So there's definitely options on shifting income off of you and on your parents and on your kids and your grandkids. So really cool. This is how I was able to save thousands. Oh, Tina, yes, this is how I was able to save thousands of dollars. My CPA I used for 10 years never told me about this, so I lost a lot of income until I found Courtney. Thank you, Tina. I appreciate you. What states do we handle? So we do taxes in every state. So I don't think I shared that, but I am what's called an enrolled agent, which is, or EA for short, is the only credential that you can get from the IRS. So CPAs are a state board. Their focus is financial reporting. So they do audits for big companies, and they can do, publicly traded companies. They do financial reporting like bookkeeping. That is the majority of what they do. As far as an EA, I have the ability to go to all the way up to tax court with you. So it's the only credential you can get from the IRS. CPA is a state board that through the American Association of our American Institute of CPAs. So they typically only practice in a state, but we have clients in all 50 states who have over 2,500 tax returns that we prepare every year. This is so good. Great refresher. Thanks so much, Betty. Will we get a recording of this meeting? Yes, I'm going to send a recording of this to everybody as soon as it's downloaded. It'll probably be tomorrow. I'll send you that. And then we talked about grandchildren. Yes. And so you can hire, and I just want to be very clear, you can hire your kids over the age of 18 as well. It's just that you would have to withhold FICA taxes on them and you pay the matching FICA. So that's 15.3% in taxes. If you're in a 22% tax bracket or a 24% tax bracket or 32, then obviously you're still saving that much money by hiring your kids. So we just look under the age of 18 is just a no-brainer. If we live in a different state, who do we get all of our tax? How do we get all of our tax info to you? So we have a management system that you upload all of your documents to, sign your engagement letter, answer some questions. So all of that's done electronically. And then, everything's sent to you electronically to sign in a DocuSign. You sign the returns, we e-file the returns. You get your typically direct deposit. If it's a refund, you're going to get that in 2 to 3 weeks. And then you print out the voucher to mail in the payment if you have a payment. So again, I probably have more clients in the state of California than I do in the state of South Carolina. And I'm in South Carolina only because their tax laws are so crazy there. We get a lot of referrals there. So if you're on Social Security and have a home-based business, are you still required to pay self-employment taxes married to a W employee filing jointly? Yes, regardless of if you have Social Security or not, you are required by law to pay self-employment taxes unless you have an LLC treated as an S corporation, so we can bypass 80% of those. So yes, that is correct. But the big thing about that is that on paper, right, you could potentially show a loss, and that would offset against the income that you have, which would decrease your Social Security taxable income, and which Trump is supposed to be getting rid of that anyway in the next couple months. So that's a good thing. Heather said, my husband has a full-time W-2 job. We pay a portion of our insurance premiums and have an HSA through his employee that we contribute to. Can I still hire him and create an HRA to write off our premiums, our HSA contributions, and all natural medical treatments not covered by insurance? So You wouldn't use the HSA for any, I mean, you could run things through it, but the HRA is going to be better because HRA actually wipes out the FICA taxes that you would be paying as opposed to the HSA does not. You still have to pay FICA through an HSA. And then, yes, you can write off the natural medical treatments. All of that can be written off, plus the premium that you pay if that premium is not already pre-tax. A lot of times employers, they already have plans set in place that pre-tax the insurance premium. So if it's not already pre-tax, then yes, we can write that off. Angela said, if you are a W-2 employee and your business expenses are more than your business income, is there a timeline you need to report a net income from your business versus a loss? So here's the law on that. Your business can have a loss every year. Okay. I actually had a client that had a loss for 25 years. It was $100,000 a year. I don't suggest that, but she did have a loss every year. Amazon had a loss for 11 years before they ever made $1. Most businesses, especially the tech industry, go into losses, after loss for years and years and years. So the whole caveat is that if you are attempting to earn income and you have losses over and above income for more than 3 years, then the burden of proof goes back onto you to prove that to the IRS that you're not practicing a hobby, that you're in fact attempting to earn income. And so as long as you can prove that by calendars, it could be, showing social media ads or social media content that you're attempting to earn income, then you can continue taking those losses forever. Obviously, the goal is to make money, right? Even on paper, you want to eventually make money, but there is no law against taking advantage of the tax deductions and the net loss. You just need to make sure that you are truly attempting to earn income. They're so patient too. Okay, Rose, when would I start hiring my 20-year-old? You can hire them now and you pay for college education. So we'd look at the the tax bracket that you're in, comparable to the tax bracket that your child is in, and then determine whether it's in your best interest. So if they're over the age of 18, you have to withhold FICA. They pay matching FICA. So there's 15.3%. So if you're in a 24%, then that's going to save you 9% in taxes. If you're in, but that's federal and state. So whatever federal and state. So let's say it's 30% total. You're paying 15.3%, and they fall in the guidelines that their standard deduction has not been met. So the first 15,000 is taxed over here at 15.3 total, including self-employment taxes. And over here, you've got 30%. So definitely makes sense. Rachel, are there requirements on who can donate money to through your business? Where clients can I just email and get some additional info? Yes. So I'll just answer that question, probably be the easiest. You have to give to a 501c3. That is the caveat when you're given as far as charitable contributions. You can't just give to an individual. It has to be through a 501c3. So if there's not something out there that you want to give to, then you could set up your own 501c3. Obviously, there's a lot more detail into that, but you could start giving into that if that's what you wanted to do, and start providing to individuals through that way. Tracy, does the bookkeeping software allow you to do estimates, invoices, accounts receivable, or is it just to keep track of your tax and expenses? So yes, I believe it does. I know it does invoicing. It will do accounts receivable. But if you're looking for something like that and your business is probably more than $150,000 a year, I would say you probably want to stick with QuickBooks at this point, because they just have a whole lot more. They're easier to track, especially because you can pay clients can pay their invoices through QuickBooks. It reconciles everything back to the bank deposit, so it saves a ton of time. I would have to have a full-time person doing nothing but tracking our payments that clients make on a daily basis if I had any other software. So I probably would stick to QuickBooks at that point. Kathleen, are the times to sign up to meet with you Eastern Standard Time? It should be your time. So it'll ask you what your time is. whether it's Eastern Standard Time or Central Standard Time, and it's going to put in your availability. Sherry, if we hire you, all are all associated bookkeeping and tax prep cost deductible? Yes. Anything legal and professional. So setting up an LLC, setting up an S corp, bookkeeping, payroll services, everything is tax deductible. That's considered legal and professional fees. So yes. FICA taxes are 7.65% rose, and then you pay matching FICA of 7.65. So the employee pays 7.65, the employer pays 7.65. That's where you get the self-employment taxes if you're self-employed, because you have to pay both, which is 15.3%. All right, and I think we talked about, should I wait to hire my 20-year-old till I make more money? It really just has to do with your tax bracket. So where they're at in their tax bracket. And one of the bigger pictures is being able to write off like the continuing education and the auto reimbursement. And also we talked about the college education. So you can write off $52.50 a year and not have to pay tax on that at all. So the employee doesn't pay taxes on it and you get to write it off as a tax deduction. So we can definitely look at that. Shelley, can you write off anything with having health sharing? If you have an HRA, yes. 100% tax deduction. So medical bills, medical insurance, and health savings can all be tax deductible if you have that HRA in place. If you have more than $5,000 a year and all of those things combined, it's beneficial to do the HRA. And the reason why, the HRA is either $595 a year to set up or $695. So I can connect you to Dan at Task is a company that we work with, and they're a benefit administrator, and they set it all up. They also give you a debit card that you can link to your business or personal bank account. It really doesn't matter. And every time you swipe it, it actually tracks all of your medical spending. And so once a year, you print out a report, give that report to us, and that tells us all your medical bills. Granted, you don't have to use that debit card in order to take benefit of the medical bills and medical insurance and medical sharing, but it's just easier to keep track of. Okay, so Heather said we have rental property. I had a coaching business and a network marketing business. Do I need an LLC for each? Coaching and network marketing, no, those can be combined together. And frankly, any network marketing business can be combined with anything you're currently doing. So when I was doing network marketing, OTB Tax owned my network marketing positions. Obviously, I don't do network marketing anymore. I can't. That would be a conflict of interest. But all of my positions were owned by my company. So whatever you're making the most income at, that would be kind of the industry code that we would consider you to be. And then network marketing can fall under that. Rental properties, you don't need an LLC for rental property for tax purposes because you don't have to pay self-employment taxes on rental income. But the caveat to that is that you need an LLC to limit the liability for the rental property. So that would be a really good idea. The problem with being able to get an LLC for a rental property or get it in the LLC name is that a lot of times banks will not give you the loan in the LLC name, and obviously the deed's not going to be in the LLC name. So that's another whole story. But yes, do I suggest having an LLC if you have a rental property? Yes, but it's not going to help you for tax purposes. And then the network marketing and coaching, they can all be combined into one. Husband's looking to start a DJ business. This is Roxanne, a business for small events. Since he's just starting out, it's best to set up as an LLC as opposed to a sole proprietorship. So I look at liability. As a DJ, if he's doing wedding events and he doesn't show up and somebody sues him for that, there's liability there. So I definitely say it would be a good idea to get an LLC, period. Just for the liability purposes. And then obviously as he continues to grow, most states are very inexpensive. The most is California that charges yearly. So if you're in California, then I would kind of steer away from the LLC until you need to treat it as an S corporation for tax purposes. But every other state, it's typically a couple $100 to get it set up. As far as their fees, we charge $250 to set up the LLC, get the articles and the EIN, so we can definitely help you with that. And some states are as low as $50. So it just depends on the state on how much they charge. But to me, it's definitely beneficial in any business that you start that you have an LLC. Mary, can a single person use an HRA for insurance and medical deductions? So if you have an S corp, yes, but it's specifically related to employee benefits. So you wouldn't use the HRA unless you had employees. So either you have a spouse that we can set up the HRA for, and pay that spouse as an employee benefit. If you're single, then you would have to go through the S corp route. Which is not quite as beneficial because you do have to pay self-employment taxes on that. So, but if you have a lot of medical bills, it may definitely be worth it, and we can look at that during a call. Sherry says, is there a special type of bank account that is an HRA or any account that's dedicated to health payments? So the HRA is a reimbursement account, and it's literally, there's no account that's set up. It connects to your bank account. So when you either can use their debit card, and that can be connected back to your personal or business bank account, and you can swap that, or you can spend on medical bills as you currently do, whether it's through a credit card or whatever. You just keep track of those receipts and upload those into Task, which is the benefit administrator that handles that, and then they provide a report on your total medical bills, total medical insurance, and then we get that and we do the tax return based upon that. Okay, whew. I've talked a lot. Thank you, thank you. Thanks, guys. Thanks, Kathleen. Thanks, Karen. I appreciate y'all. Good, Tasha. The more you hear it, the more you retain. Yes, it's a lot of stuff. And there are hundreds of other tax deductions I could talk about, but it's just too much for people to grasp all at one time. So I am working on a longer training. It will be a paid training that we will start doing probably in the next couple months. Just because people need this information, and obviously I can't do this in a 15-minute or a 30-minute tax strategy session, and so it gives you ideas on what all you can do to take advantage of these deductions. So anyway, book your 15-minute tax strategy session. You're welcome, once you get this link of the recording, you're welcome to share that with anybody you want to share it with. I will expect to have this baby in the next week or two, so if you get on my calendar, granted, I may have to rebook you, just so you know. But as of right now, this week is open, and hopefully next week will be good too. But we'll take care of you. So I only do strategy in the office, so my staff handles everything else. From preparing the tax returns to e-filing and everything in between. So they can definitely help you until I come back off of my 1 to 2 weeks of maternity leave. And then I'll take some time off after April 15th. So I appreciate you guys. Anything, I think I've gone through all the questions. And if you have any other questions, you're welcome to email me. All right. Have a great day.